So we have one.
Good afternoon, everyone. If we can just have a little bit of your patience to allow the rest of the attendees to join before we actually start the webinar. Thank you. Thank you, everyone, for your patience. I think a number of our guests might be slightly delayed, but in the interest of time, I think we should get started. Helen, if you please.
Yeah, sure. Thank you, Thomas. So, ladies and gentlemen, welcome to this Acclime webinar on Regional Tax Insight, Navigating New Tax Compliance Regulations in Asia. My name is Helen Wong, based in Hong Kong and leading the tax practice in Hong Kong. I'm the moderator for today's forum. So I want to show you the agenda for today. Next slide, please. Okay, so in today's webinar, we will first present you some key tax updates on 3 jurisdictions, Singapore, China, and Hong Kong. Secondly, we will give a brief introduction of the recent popular topic, which is transfer pricing. And lastly, we will present 2 case studies that might be relevant to our audience today. You might, at some point in your restructuring or business modeling, what certain tax implications that you might encounter. And I hope that today's case will be able to cover some of the aspects and walk through it with you. So before we start, just some housekeeping. So throughout this presentation, we have made available the chat box. If you have any questions anytime during the presentation, please feel free to drop it down, and we try to take care more questions later during the Q&A session. Okay, so next slide, our presenter profile. So we have 3 panelists today, including myself. So just a brief background about myself. I look after the tax compliance and advisory issues primarily in Hong Kong, but has extensive regional transfer pricing compliance and planning experience for listed and MNC clients. So it's actually my pleasure today to have two of my fellow colleagues from Singapore and China to join me today in this webinar. I will give them the liberty to talk more about on their expertise later on, but now let me first introduce. So first, we have Mr. Thomas Chan, the Managing Director of Acclime Singapore, and Ms. Mandy Liu, Associate Director of Acclime China. So before we start, I like to share a few words about our company. So Acclime is the leading pan-Asian corporate service specialist. Our the differentiated strategies are exclusive Asia focus for market leadership in emerging Asia. We have key offices in China, Hong Kong, and Singapore. We support our clients with their market entry strategy, setting up legal entities, handling bookkeeping, tax compliance, as well as many other services for companies operating in the region. So in the next slide, you can see that we have presence in 14 jurisdictions and over 1,200 people in the region. In case you need local support in any of these specific jurisdictions, we have the capability and resources to support you and reach out to you. Okay, so that's a short introduction about our company. And next, we're going to jump on the tax update. So first, we'll bring you the tax update from Singapore, and I would now hand over to Tom. Tom, please go ahead.
Thanks, Helen. Good afternoon, everyone. Just a quick introduction, but before that, I think we do have some good news to share. The 14 jurisdictions that Helen just introduced has been increased to 16. So, it's really something that we keep updated almost daily these days with all the changes that goes on in our organization. We are growing from strength to strength. But in any case, just a short introduction about myself. Before I actually joined Acclime to run the practice in Singapore, I've been looking at taxes for better part of my career for 21 years. Lastly, in terms of advising many of our international clients moving into Southeast Asia, I call Singapore home currently, but I've stayed in many countries across Asia. So as you can imagine, these days, especially those of you that have met me in my prior organization or in Acclime, you would know that I like to talk tax, and effectively, if we're starting to talk tax, I can talk all day long. But given the time restrictions today, I just like to bring 4 sort of more strategic key changes in terms of Singapore. Many of you that are moving into the region, especially with Southeast Asia, typically speaking, many of you would also have holding companies in Singapore or some legacy structures that you might have inherited. So from that perspective, as the BEPS 2.0 initiative has really taken off, you will see that many countries have implemented the global anti-base erosion rules as well as domestic top-up tax. So what that really means is that if you do have or enjoy certain tax incentives, for example, in a jurisdiction, and effectively that brings your effective tax rate below 15%, quite typically, your holding company's home jurisdiction might actually ask you to pay some top-up taxes. Of course, there are cut-off amounts. For example, I've listed one here. Your consolidated revenue needs to be euro 750 million and above. But as with regards to international MNCs that are actually investing through Singapore into the region, this, of course, is not a sizable amount, and many of our clients would actually exceed those revenue numbers already. But given the fact that in Singapore we do have a number of tax incentives which are available for MNCs that are investing either substantial operations in Singapore or are placing many of their key tax members or board members in Singapore, and of course investing into the region, this is an important sort of change. Nevertheless, although the Singapore government has mentioned that they will take effect from 1st of January 2025, Singapore does take this very seriously and will only likely announce the more detailed rules when we have some visibility in terms of what the rest of the region as well as our global partners would actually be taking on in terms of the domestic top-up tax. It's a bit of a mouthful. Secondly, in line with many of the expectations, Singapore has introduced the taxation of gains on the sale of foreign assets. So if you do have gains from the disposal of immovable or movable properties situated outside Singapore, this may be subject to tax effective from 1st of January 2024. But of course, there are exceptions, and one of which would be either you're a pure equity holding company, which many of you would have in Singapore, or that there's actually adequate economic substance, be it within the same entity or within related companies. But nevertheless, that really leads on to our next key update, which really is about the fact that there's a lot more focus in Singapore, but also outside of Singapore in terms of having business substance. So, for example, as you know, many of the companies would be holding assets in a Singapore holding company, typically to leverage off Singapore's wide array of double tax treaties with many different jurisdictions. So in order to be able to rely on many of these double tax treaties, of course, many paying jurisdictions would expect the Singapore entity to produce a certificate of residency. But in order to be seen as being a responsible player in the international market, of course, the Singapore Tax Authority does look into a lot more details to make sure that the entity is actually having some business substance in Singapore before it will issue a certificate of residency. So there's a lot more expectations, I would say, that has grown over time. Even from a bank opening perspective, we do see that on a day-to-day basis, before actually, opening bank accounts, the banks are asking a lot more questions in terms of, who is it that will be based in Singapore? What are the type of activities that you are going to be doing in Singapore itself before actually helping investors open their bank accounts? So by and large, there are, of course, exceptions. But you do see a lot more focus in terms of ensuring that there are actual business activities carried out in Singapore. Lastly, you can, from an international standpoint, see that there's a lot more focus in terms of indirect taxes over the course of a number of years. Singapore is no different. We have been increasing gradually the goods and services tax, which is the Singapore version of the VAT. Over a number of years. So as recently as 1st of January 2023, so earlier this year, we introduced the increase from 7 to 8% on the goods and services tax. This generally is charged onto domestic consumption. So effectively, it will increase again from 8 to 9%, effective from 1st of January 2024. So you can see that Singapore is gradually rebalancing how we raise our tax revenue, but at the same time, making sure that we're still competitive, as well as making sure that we are a responsible tax jurisdiction. So I'll pass it on to Mandy, who will give you some updates in relation to China. Mandy, please.
Yeah, thank you, Tom. Hello, everyone. I'm Mandy Liu. I'm leading one of the accounting and tax team here at Acclime China. I have overall 13 years experience working in the finance and tax field, including 10 years specifically in the audit and also professional service industry, mainly helping foreign clients to set up entity in China and also the ongoing accounting and tax compliance work and advisories. So it's my pleasure to give you some tax update from the China side. This year, China is facing a slow growth rate, as you all know, and also according to the statistic by the Ministry of Commerce, the foreign direct investment dropped slightly by 2.7% in the first half. But as China wants to continue to attract the foreign investments and also support business, it has released multiple tax cut policies which are relevant to the foreign investors and also the foreigners in China. So firstly, I want to introduce the good news for the individuals working in China. Foreigners' fringe benefits will continue to be tax exempted until the end of 2027. This includes in total 8 kinds of benefits, such as rental and children education allowances, and also the one-time bonus preferential treatment will continue to apply, which will benefit both the local and foreign employees. And secondly, besides the individuals, there are also multiple preferential tax rates to support business. For companies that can be qualified as small and low profit enterprise, they can enjoy a corporate income tax rate that is only 5%, which is 20% lower than the standard rate of 25%. And also for the small VAT payers, the tax rate is reduced to 1% from the standard rate of 3%. And also, as China is pushing the local manufacturing, there are multiple tax cut policies for the local manufacturers with R&D abilities and activities in China. And we also like to mention that many local governments are still providing the subsidy to attract investments or relocation projects. The common ways can be a rental allowance for 2 to 3 years and tax refunds. So if your company is considering to expand investment or relocate, subsidies provided by the different cities and industrial zones will definitely be a factor to consider. And Acclime will be happy to schedule a detailed discussion with you to assess the possible benefit or subsidies your China company is able to enjoy. And besides the benefits, I also want to mention an important update that China Tax Authority is pushing the fully digitized invoice, which have some key features such as it no longer require the invoice machine or golden text USB disk, and also it can provide unlimited number of invoice, which brings efficiency to tax and invoice handling process. And even though I mentioned a lot of policies that provide benefits to the business, we have also noticed that this year the China Tax Authority is very active to check for potential underpayment of tax. And here we have listed some of the recent focus areas that the company shall pay attention to and do some self-checking. For example, we have noticed that authority asking company to justify the business substance for consulting or service invoices that they receive, and also for stamp duty and withholding tax payment. These areas are often overlooked and may trigger penalties or late fees. And also for the transfer pricing, we have seen that even if the company does not meet the mandatory threshold to prepare the transfer pricing documents in China, the authority might still ask questions or conduct investigation. And some of the common trigger points would be the company pays out large intercompany service bills to abroad while it's making losses, or it can be the company has jumping gross margin rate or net profit rate over the years. And the last point I would like to mention is related to the profit repatriation. From our experience helping our foreign clients to pay dividends, the process is still quite smooth and fast. But one thing I would like to remind is that if company apply the preferential dividend tax rate according to the tax treaty, the authority often will conduct a post investigation, and the main checking point is whether the shareholder has certificate of residency. which is a precondition to apply the tax rate according to the tax treaty. Yeah, so these are all the updates from the China side. Then I will pass to Helen for the Hong Kong part update.
Thank you, Mandy. So down to me now for the Hong Kong tax updates. So my first three updates are actually very similar to Singapore's recent tax developments, especially in the area of new type of taxable income that was not taxable before, and then also the alignment affecting both jurisdictions in terms of the BEPS 2.0 initiatives. So the first one is the foreign source income exemption. That is actually a major change to a Hong Kong tax landscape where Hong Kong companies who are member of a MNC, and then the company itself has without economic substance, we now have to pay tax on passive incomes, specifically on interest, dividends, disposal gains from the equity sale of equity share, and also income from intellectual property. So the first three types of income, which are non-IP type of income, the keyword is still around economic substance, as we have mentioned several times already for the past two updates. So similar to what Tom has shared in the Singapore update, the Hong Kong Tax Authority uses a similar criteria to substantiate economic activities to evaluate whether the income can be tax exempted. So there also, Hong Kong has a lot of pure equity holding companies. So for those type of company, they have a reduced requirement such as fulfilling the annual company registry filing, including filing a return, and that should be a sufficient ground to get them also exempted with certain restrictions. However, for the offshore IP income, the nexus approach will apply. So what the nexus approach is really about actually relates to the proportion of the passive income not taxable against how much the entire R&D expenses were incurred in the Hong Kong-based R&D activities. So the higher the R&D expenses incurred in the book of the Hong Kong entity, the likelihood the same portion of the passive income from the intellectual property income will likely be exempted as well. So, however, within 6 months of the new implementation of the FSIE regime in January, there was another reform because EU was considered the original criteria to be too restrictive. So one of the key changes was on the disposal gain. Earlier, we said that it only covered the equity interest transfer, but now it extends beyond to disposal gain for the sale of intellectual property. So this will come into effect also in 2024. And actually, we will have more discussion of this implication in one of our case studies later because it involves the sale of a software IP. So we're going to talk about more on that one. The third one is the minimum tax rate. So Hong Kong will also follow the BEPS 2.0 initiatives. For M&E over Euro 700 million revenue, they will also apply the 15% minimum tax rate, so same as Singapore. So this minimum tax rate was originally intended to implement in 2024, but now we push 1 year back, and so it might be a good news for some of the M&Es to get themselves prepared for this new initiative. The fourth one is quite interesting news about stamp duty, because as most of you know that Hong Kong is one of the most expensive places to live, and with strikingly high property prices. So the recent policy address from our government 2 weeks ago gave way to a more lenient tax cut on the stamp duty. Now half of 15% for Hong Kong, non-Hong Kong permanent residents who wants to own a property in Hong Kong. So at the same time as we are trying to attract more talents inbound, the newly arrived foreign professionals will not need to pay for stamp duty on property purchases. given they're able to obtain the permanent residency in the near future. So it's quite counter to our friend in Singapore, who actually just doubled the stamp duty to 60% for foreigners purchase, a measure that they implemented in order to pull down the property prices in Singapore. So let's see how this will go for a lot of the investors out there attempting or individuals who wants to make a property purchase. But definitely we see this measure as being a benefit more on the developers. And quite short-lived actually for investor, because the interest rates right now it's still very high. So this is a heavier cost of burden for financing the property. Other minor key updates includes that while Hong Kong we still don't have GST or VAT implementation, and unlikely to come into law in the near future because it's unlikely that our government would want to expand the tax base to remain more competitive. But at the same time, as we're trying to recover the economy, we have a lot of concessionary tax rates measure coming in for IT business who wants to establish a headquarter in or regional hub in Hong Kong. So there is nicer tax rates for the IP income, and as well with one not in this slide, but as we're also trying to attract more family offices from a finance perspective, there's also other concessionary tax rates applied for interest or other treasury income. So these are the updates for Hong Kong as well with 2 other jurisdictions. I hope this is a informative short session to let you have a taste of what's going on with the 3 jurisdictions. Okay, so next I will touch on the topic of transfer pricing, a very special topic, but getting a lot of queries from our clients these days. So as with the increasing interactions between subsidiaries under the same group, transfer pricing becomes a very important topic. So what is transfer pricing? It is about the pricing policy for intercompany transactions. So there are different types of transactions, such as the very common one are the intercompany purchases and sales of goods between related parties. Another one is the support service. So for example, in Asia, most of the regional hub would be either Hong Kong, Japan, or Singapore. But so at the same time, the regional hub will offer centralized operational support on the area of IT, risk, HR, finance, and other operational support to the subsidiaries in the same group. So this is actually one of the most common intercompany transactions we've encountered with several of our clients. And as Mandy also mentioned, in China, there's quite a lot of queries about this type of transactions. And then the third one is also growing into more common. It's the intercompany loans. So there are intercompany borrowings and lendings to subsidiaries and to manage some liquidity challenge. So in that case, the tax regulators, they're also expecting that even within the related parties, they're going to charge a reasonable cost of funding between each other. So these are the typical transactions that we see from a transfer pricing perspective. So because of this type of related parties interaction, it gave way to a mechanism where subsidiaries can reallocate profits and costs to another sister company. So there's an advantage that profit can be parked in a lower tax jurisdictions, or maybe even in zero tax jurisdictions like BVI. So this essentially lowered the group effective tax costs, but it also incurs a profit shifting risk. So this is not quite a good news for a lot of the local tax authorities, because they may not be getting a fair share of the tax that they deserve after the reallocation of profits. So in order to align this from the regulator's perspective, the subsidiary should only get the deserving revenue commensurate to the key activities performed in that entity, or pay the cost of service that is in proportion to the benefits received. So the way to benchmark reasonableness is that from the tax authorities, they would see that the company should charge related parties for similar services or goods in the same way that it will be charged to an independent party. I actually like to, so this is what they call an arm's length principle. So I want to repeat again, this is a very important statement, that the way to benchmark reasonableness is that the company can charge related parties for the similar services or goods in the same way it will be charged to independent parties. So you're not overpaying or underpaying anything just because your sister companies is part of the family. So it has to be fair as how you're treating with another independent service providers or your clients. So the keywords on transfer pricing, if you have to walk away with some new understanding on that, it's the transfer pricing is about related party transactions, arm's length principle, and benchmarking. So these three keywords are the very essential principle around transfer pricing. So as you can see in the slide, I actually do have a illustrative example. So here, Hong Kong being the regional hub, they provide the finance, marketing, IT services to the Korea and Japan subsidiaries. So this Korea and Japan entities, they did receive a benefit from the operational support from Hong Kong, probably because if they do not receive that, they have to go to seek a independent service provider to provide the similar services. And due factors such as economies of scale, the regional hub will be able to centralize all this function and distribute it to or contribute it to different subsidiaries in the same region under a lower cost. So from that perspective, these subsidiaries, including Korea and Japan, they are justified to receive the benefit. So treating them as if it is independent providers, then they have to remunerate a service and then with a margin. So in this case, it's a cost plus 10%. So there are actually also some other key considerations how tax regulators look at arm's length standard. So the first one is a contextual value creation. So what it means is actually the activities being performed by a certain subsidiary. What is whether this is a routine function or it's a high value added function that would eventually contribute to deriving a profit. So if this is for example, in my previous illustration, the IT support in the context of a trading company or a professional service firm, the way that some of the activities might involve developing a in-house software for operational efficiency. But then within the context of a trading business or a professional service firm, this is always more on the routine and ancillary nature for that type of IT activities. But then if you're talking about software developing activities in an IT consulting company, that may be a value-added activities because it helps the company directly earn a profit. So this is how transfer pricing or regulators characterize the type of activities being a routine or value-added. So then to the second question. Now, if the function it's a more value added where the entity also undertakes risk or ownership of certain assets in order to derive the trading profit, then what is the pricing policy that is enough? So cost plus is more on the routine type of activities. But then, as I've said, if the IT developing skills or this type of activities, it's being in the context of an IT consulting firm, then probably the regulators will not be satisfied with just a cost plus remuneration, but more on a revenue sharing. So that's also where we have to justify the appropriateness of using which policy to remunerate the services or goods. And then down to the third question, it's how much is enough? We're talking about cost plus. So is cost plus 5% or cost plus 10% enough for a routine type of services. So these are other considerations that we have to take into when we have transfer pricing activities or interactions between the subsidiaries in the same group. So this is a very succinct, short introduction on transfer pricing. I can actually go on and now to talk about the details, but we don't have enough time. But at least for people who are not familiar or first time hearing transfer pricing today, I hope this gives you a taste of what it is about and also the implication to your business. Okay, next slide, please. So basically, most of the tax jurisdictions or the countries, they have already implementing transfer pricing documentation requirements. That means that if your business already have undertaken certain type of related party transaction and the volume is large, you are likely to require preparing TP reports to document your transactions, your pricing policy, and also disclosing certain level of group and your local company information. So this chart, we intend to show you the overview in the APAC region, where a lot of these jurisdictions already need to prepare reports, but then the threshold is very different across different the countries or jurisdictions. For example, in Hong Kong, it's actually, they have a very high threshold, meaning that it takes a lot of qualifications for taxpayer to have to prepare the report. So for example, the Hong Kong company needs to, from a business size perspective, they need to have a gross revenue of Hong Kong $400 million, and then asset size of $300 million in order to qualify for the business size. So, and at the same time, maybe the related party transactions, for example, services type, and it exceeds 44 million, that means that you already need to prepare a report. So if your related party transactions exceed the threshold, but you did not exceed the business size, that means that you're not going to need to produce a report. That's actually good news for some of the SMEs in Hong Kong, because it's least likely that you will meet such a big business size threshold. So, but that is very different in Malaysia. If you can just take a look at that column, you actually see that there are other criteria which make the taxpayer needing to prepare a report. So one of the criteria is under Section C, where if you already transact with entities with lower tax rate jurisdictions, that means if you already have even a 1 million related party transactions amount with Singapore, Hong Kong, which has 16.5 or 17% corporate tax rate, you already need to prepare a filing. So it's either a full or simplified version. So this table is just overview for you to understand, and also an indication that if you already have related party transactions, that's already a red flag for you to evaluate your status. At the same time, if you have business under any of these jurisdictions, you might have easily fall into that threshold where you have to prepare the report. So this is for your reference, and if that's the case that's happening to you, we definitely welcome you to get in touch with us so we can help you to do a basic evaluation and see where you are and how we can further support you. Okay, so that's it for transfer pricing, and the next probably the highlight of today's webinar is we're going to talk about 2 case studies with tax implications. So without further ado, I hand over the time to Tom to walk us through on case 1.
Thanks. So in the interest of time, I am conscious that we don't have much time left, and I'm sure everyone has some questions in which they want to. I think some have also sent us ahead of time some questions, but nevertheless, just want to remind everyone that there is a Q&A tab at the bottom of your screen. So if you have got additional questions that you would like to raise with the panelists, feel free to drop them in there. especially in relation to the case studies, and we'll be happy to address as many of them as possible. In any case, on to case one. This is actually a client of mine that have followed me through two different lifetimes in terms of professional services. So effectively, they went through multiple mergers and acquisitions across Asia, and also they had a Hong Kong entity which held some level of intellectual property. And for the purposes of their business, they had to make sure that the intellectual property is licensed to both related parties and non-related parties in both Hong Kong as well as in many other parts of Southeast Asia. So the Hong Kong entity was actually deriving for a number of years royalty income. As you can imagine, when paying out royalty income or license rights to Hong Kong, many of the jurisdictions would have withheld on the payments before the Hong Kong entity would receive them. When this client approached us, or myself, basically they were looking to restructure that primarily because they had an entity in Singapore which was heavily involved in terms of the further enhancement as well as the management of the IP. So really, they wanted to make sure that, as we mentioned earlier, so they were slightly ahead of their time. They were trying to align their business substance with the holding of their IP, just to make sure that in the longer term sense, this was something that they were prepared to. So for several different reasons, the decision was actually undertaken to shift the IP from Hong Kong into Singapore for the value at that point in time. So fortunately for them, of course, the IP did grow in value quite substantially subsequently, but in any case, they had already transferred it to Singapore. And then the Singapore entity was, of course, licensing those rights back to Hong Kong as well as to other Southeast Asian countries. Of course, the upside, in which I'll talk about later, is in relation to the tax implications from a group perspective, how that they actually benefited from that, both in Singapore as well as the cross-border payments. But I'll just get Helen to quickly walk through, some of the implications during the transfer as well as the issues from a Hong Kong perspective before I step in. Helen, please.
Sure. Okay. So yes, so this is the case that involves the FSIE implication that we talked about earlier, and the timing was a bit interesting. Before or in 2024, or if they have now will do it in 2025, the implication for the disposal gain is totally different. So just a bit of the background on the Hong Kong company before the IP was transferred is that the Hong Kong company basically has no economic substance, doesn't have office, no people, but they do receive regular IP income from non-Hong Kong entities, including related and non-related parties. So they claim that offshore income since day one. So, in Hong Kong, we apply a territorial concept where offshore income is not taxable. So in which they later have a plan to consider transferring the IP ownership to the Singapore. So there's a bit of Hong Kong tax issues involved. First, the disposal gain. So as we have mentioned a while ago, that the FSIE impact on the company like this with no economic substance, the disposal gain now, which was gazetted after 2023 effective next year, if they do the transfer by then this disposal gain might very likely be subject to tax. However, before that, since the gain was never a taxable income in Hong Kong, it was not a concern. But then it might be very different now, 2 months from now, so earlier November. So we have some kinds like this coming to us, how we deal with it. So often our advice is sell whatever you can and get yourself non-taxable before this new law comes into effect. Okay, and then secondly, the IP income also. So if the transfer was not made and remain in Hong Kong after 2024, then that falls into one of the passive income category, the IP income, and then the nexus approach will likely apply. So certain part of the income might not be taxable in proportion to the R&D expense criteria based on the nexus approach. So, and then thirdly, because of this transfer, it might also trigger the IRD to challenge on the disposal gain. Because with more understanding on this case, we realize that the holding period was not actually very long, more than a year. So that might be another factors where the IRD or tax authority will treat that whether this is a capital or it's a revenue in nature. So some factors that we usually factor into to do the evaluation is the holding period, the badges of trade factors, and it all depends on the totality of facts. So that's from the Hong Kong side. So I hand it back to Thomas for the Singapore side.
Thanks, Helen. So as you can imagine, from a Singapore perspective, of course, aside from the alignment of substance as well as holding, clearly from a broader perspective of leveraging on Singapore's tax treaties, because fortuitously they had already set up a Singapore company some time back. They had a fair number of employees, key decision makers that were actually sitting in Singapore. So of course, in terms of relying on the tax treaties in Singapore, clearly, the IRAS would not have an issue in terms of issuing them with a certificate of residency. And because they continue to leverage, in terms of the R&D capability, so from a Singapore perspective, they would be able to claim some of the write-down in terms of the intellectual property for the shift into Singapore. So both from a withholding tax perspective as well as a corporate tax perspective, even if they were to suffer withholding taxes, which would have likely been reduced as a result of the ability to access a lot of the tax treaties between Singapore and the rest of the jurisdiction. Of course, they really, in the longer term, wanted to make sure that they continue to be able to access those tax treaty benefits. So that was really one of the key points. I see that we're actually a little bit short in terms of time, so I won't belay the point, and I'm sure we can address some of the additional questions from the audience when we move in the Q&A section. If I can hand it off for case study number 2, so we have enough time for Q&A.
Okay, so I'll go on with the case study with the background. So this is a typical company restructuring case. So the status quo is it starts with the ultimate parent entity level, which is a USA company. It holds 3 levels of companies, as you can see in the diagram, respectively Hong Kong, Singapore, and China WUFI, which is a wholly foreign-owned enterprise, China subsidiary under the Hong Kong trading company. So what they actually wanted to do is they are going to deregister the Hong Kong trading company. So in that way, the China WUFI would need to find a new parent. And while we also evaluate this structure, we also understand that they're undertaking some interactions, intercompany transactions as well. So we talk that it involves various tax disciplines in this case, but for this case study, perhaps I will hand over to Mandy first to talk about the China tax implication, and back to me to touch on other areas.
Thank you, Helen. So from the China side, the main tax implication on the WUFI's ownership change would be for the dividend tax, as well as for the capital gain tax. So before the restructuring, the WUFI is 100% owned by the Hong Kong company. And according to the tax treaty between China and Hong Kong, the dividend can apply the 5% preferential tax rate. But of course, as mentioned before, the Hong Kong entity need to obtain the certificate of residence in order to prove its economic substance to apply this preferential rate. And according to the restructuring proposal in this case, the WFOE will be, after restructuring, 100% owned by the US entity. And according to the treaty between China and US, the dividend tax rate is 10%, which is basically the standard rate, no reductions, which means that after the restructure, there will be 5% more tax cost concerning the dividend payment from China to the shareholder. And another tax consideration is for the ownership change. Even though from the global perspective, the restructure is completely an internal restructure and does not generate any income. But from the China tax perspective, the ownership change will be considered as the Hong Kong company sells the China WFOE's shares to the US company, and the Hong Kong company is obligated to report capital gain from this transaction and be taxed at 10% in China. And the capital gain tax will be determined based on the difference between the share transfer price and the capital investment to the China entity. And so many companies will set the share transfer price at just $1 to avoid this tax cut, the China tax authority might still challenge this and adjust based on the fair value of the shares. So these are the tax implications from the China perspective. And now I would pass on back to Helen to comment on the other considerations from global and transfer pricing perspective.
Yeah, so I'll just go quick as we have already talked about transfer pricing. So the fact that we see that the companies in the group structure, they have undertaken certain interaction, which the client was never aware the transfer pricing compliance or implication. And since we have evaluated that on an integrated basis, we have the opportunity to identify other tax issues that they were not even aware of. So on top of what Mandy has addressed in some of the capital gain or withholding tax issues in the dividend upstream or related party transactions, this was a very good case for us, enabling us to coming up from different tax expertise or the discipline, but then we were able to offer them a integrated advice and able to help them to manage the risk from an overall perspectives. So these are the two case studies that we have today. We hope that this brings you some insights or maybe some of the similar activities that you have incurred and or about to undertake. If this is implication that is relevant to you, then we are really here to help and support you. So before we go into the Q&A sessions, we do have some key takeaways, main points for you to go home with. And so I pass the time to Tom.
Thanks, Helen. So, we spent the last 50 minutes, 55 minutes talking about tax. So I do recognize that not everyone is as enthusiastic about tax as the three of us. So if you cannot remember a lot of the things that Helen, Mandy has said or what I've shared, and you like to have something to share with your colleagues in terms of, what should they pay attention to? Just remember these 3 points. I think this cuts across many different jurisdictions in Asia and beyond today. So there is an increased focus in terms of your business substance, right? So if you see that effectively across the entire group, you've got, changes in terms of where you are actually having people and so on, then it's probably time for you to look at your holding structure and what the tax implications are. Secondly, of course, as you can imagine, there's over the next 2 years going to be a lot of changes in terms of the various tax regimes, especially for key holding jurisdictions like Hong Kong, Singapore, and many of the other regional sort of popular holding jurisdictions. And it's going to have an impact for sure, especially if you have got tax incentives. Now would be the time to raise your hands and ask your tax advisors, hey, what is it that we need to do? And what is it that we need to anticipate? If you are in discussions in terms of regulators, probably understanding from their point of view what their initial reactions are going to be, it puts you in a much better position to sort of make sure that your board is appraised of the changes that are upcoming, as well as making sure that the finance team is, having some plans in terms of what needs to be changed. And then lastly, as Helen has reiterated multiple times, transfer pricing is applicable across the board, right? A lot of people might say, oh yeah, I'm too small, I don't need to do reports, but nevertheless, do remember the arm's length principle is applicable in most related party transactions, if not all of them. So even if you don't have to do reports, do take note that if you have got extensive related party transactions, that is probably something that you should pay some attention to. And we'll be happy to help you if currently we're not your tax advisors. If you do have your tax advisors, now would be the time to sort of raise some questions with them. So let's quickly move into the Q&A section. Next slide, please. So these are our contact details. I'm going to leave it there whilst we address some questions. I can see in the box that I've got a question. So before I hand it off back to Helen, I'll address this one. Hang on, let me just read this. It says, what do you mean by reviewing our holding structure after undertaking M&A in the region? So typically, a lot of our clients might have acquired various businesses, and it would have come with entities across the entire region. What that typically would mean that whilst they're going through that restructuring, more likely than not, they would have absorbed many of the core functions back into their group, just to make sure that there's some level of alignment in terms of reporting lines, in terms of where their key focus markets are. And of course, where they previously did not have coverage, they'll probably retain those entities just so they have expanded their market presence, right? But what that typically means also is that as you shift a lot of your key functions from the acquired entities' key function areas, you might have changed where you are actually having a lot of people that are serving your group, across Asia. And in some cases, they would not, be reflective. So you might have an entity that holds a lot of assets, intellectual properties, and so on, but you may no longer have people in there, which means that if there is an economic substance test that comes up, or the reliance on tax treaties where you need to apply for a certificate of residency, at that point in time, when you go for an application and you have no one there, in many circumstances, you will not be able to get the certificate of residency, in which case you may suffer a significantly higher withholding tax, or in some cases, when you do dispose of that property subsequently, you might be subject to tax. Whereas in the past, if you did have business substance, in most cases, you may not, providing that they do qualify for the exemption. So by and large, it's a good time for you to sort of review where you are. But there's no silver bullet. Most of the time, you need to go through the hard work of understanding each of the jurisdiction to make sure that that's aligned. So that's the really 30 seconds answer to that question. I think there's another question for Helen. Perhaps I'll hand it off to you.
Okay, so yes, I got one asking whether the country by country requirement is part of the TP documentation requirements. So yes, so typically tax jurisdictions, they now demand a 3-tier documentation, which includes a master file, which is a group level information, local file, country reports, and also a special file, which is the country by country reporting. So the report actually requires aggregate the tax jurisdiction-wide information relating to the global allocation of the income, the tax paid and certain indicators of the economic activities taking place in each tax jurisdictions. So it's a very extensive and quantitative documents. I've seen some that can be 20 pages, 20 spreadsheets long. So it's a nearly close full disclosure of all your related party in quantitative terms. So what a certain jurisdiction right now, if especially you're an M&E over 750 million, you are already required to file that on an annual basis. So my recommendation for our audience, if you're a M&E, I'm sure that you already received a notification from your tax jurisdiction to file that. Otherwise, if you're one of the subsidiaries in the global scale, you might be supporting your group to prepare that. And basically, it's the deadline. It follows the compliance deadline, the tax return filing, but then there's a lot of advanced works that you need to prep for. So if you have under this threshold, then please be ahead and prepare enough time to gather all this information and help the group to fulfill that requirements. Okay, so well, I think there's also a question for Mandy, right? Can you take on that one?
Yeah, thanks, Helen. So I also got one question, that is, where does the withholding obligation occurs in China? So I'll be very brief. The withholding tax is applicable to payments of income generated in China from the foreign enterprises, and the main income tax that's subject to the withholding tax in China includes mainly the dividends, as we mentioned before in the case study, and also interest and royalties paid from the Chinese entity to the foreign entities, and also service fees, payments made by the China entity to foreign entity for the service it provides within China, and also the capital gain derived from the transfer of assets located in China, such as the transfer of shares as we discussed in the case study 2. So all these transactions might trigger the withholding obligation in China. And again, we can have a separate discussion with you to review the tax compliance status for the transaction between your China entity and the foreign entity.
Okay. Thank you, Mandy. Okay, so in the interest of time, we are just overrunning 3 minutes, which is within a very good parameter. I think to respect everyone's time, we might have additional questions, or if we have not addressed, we will get back separately. Or if you still have questions after the webinar, please feel free to reach out to either one of us with the contacts below. So given that, we hope that today's session on tax updates for various jurisdictions, and as well with the special topics, case studies, you find it informative and to build more tax awareness. And if there's any point that you need support from our team, please feel free to reach out to us. So we hope to have more of this series in the future. And so thank you once again, everyone, for keeping with us for the past hour, listening to our updates. But we'll see you next time. Thank you.
Thank you so much.
Thank you.
Bye-bye. See you next time.
Bye.